All right, Access Pension Limited, a subsidiary of Access Holdings, has emerged as the second largest pension fund administrated by number of retirement savings account contributors at the end of the first quarter of 2023, following a string of acquisitions. Analysis of the distribution of total RSA accounts across PFAs in the first quarter revealed that Stanbic IBTC continued to maintain the largest share of RSA holders, 20.3%. There's Access Pensions in second place with 10.7, 1 million RSA holders. ARM Pension Managers Limited, Trust Fund Pensions Limited, and Premium Pension Limited are in second, third, fourth, and fifth place, respectively. Wale Okunrinboye, who is the Chief Investment Officer for Access Pensions, joins us to discuss further. Wale, good morning to you. Thank you so much for joining us once again.
Pleasure to be here as always.
And congrats on the acquisitions and the increase in your market share. So, look, as far as the pension space is concerned, will we see more acquisitions there? How's the space going to work out?
So I tend to look at it within the context of the wider fund management industry as a whole, because fund management really is about selling a pretty homogeneous product. And you tend to be a price taker as well. So in terms of the fees you charge, it tends to be what either the market wants. And so what you tend to find is that over time, scale becomes like a key feature everyone who's a fund manager desires. And so I think the sense you always get is that because scale always remains something that a key feature most people desire, you would always have that desire for mergers and acquisitions over time, because I mean it's a scale business, because it's a homogeneous product.
Yeah.
You're a price taker essentially, and so the only way you can really grow the business really is to scale, and the only way you can get scale.
So just pretty much, there you go. More acquisitions. Okay, looking at the reports from May from the Pension Commission, the regulator. Total, I think the net asset value, 15.5 trillion or so. I want to ask you, what does the recent move in the exchange rates do to the value of our pension assets in dollars? Is that even fair? Should I even be asking you this question? What does it do to these assets?
So I mean, we don't live. We're Nigerians ultimately, and ultimately most contributions are in naira. And so, looking at it from that perspective, in the sense that I mean. So although some people will try and compare, okay, naira has devalued, and so the value of assets would have devalued. But if you could do the same thing for almost everything, I mean, there was an article last week about the wealthiest man in Africa. I mean, it's no longer, most Nigerians are no longer there as well. If you look at Nigeria's GDP as well, you could also say the same thing. And so, yes, they could die attention, but I think the key thing to focus on really is what happens in terms of value. And I think that's probably where a lot of people have to say, okay, are we really conserving value? And what we always try to look at internally is at what rate are your pension assets growing? Is it growing at a level that's faster than the rate at which the naira is devaluing over time? And important to note, because pension funds are long-term investors, and so we tend to look at more long-term cycles. And so the question is, over the last 10 years, 20 years, relative to the rate at which the currency is being devalued, are your pension assets growing at a higher rate? And that's the kind of philosophy we take when we're investing, is to try and design a portfolio that is able to give you returns over time, because yes, you have these big shocks in the naira, but in between those shocks, the naira tends to be stable. I mean, between 2000 and 2015, the naira only lost what? 60, 70 naira. And then you didn't have a big swing over the last 8 years. And so the question is, over a longer time period, what are your investment returns relative to rate at which the currency is devalued? And then if you look at it from that light, then maybe you won't sound so miserable.
So doom and gloom. All right, speaking of the exchange rates, I props to you and all the other analysts who said, and economists who said that the naira is going to weaken over the year. Let's take a listen. You were here with us about 4 months ago, and here's what you said when I asked you about your exchange rate outlook.
Well, so for the exchange rate, I think it will be difficult to always try and put a number on the parallel.
Yeah.
I mean, so what we can look at and what we can see is the official. And for the official exchange rate, what you're seeing is that within the official windows, I mean, some of the central bank intervention sales are now taking place at closer to 500. So although officially it's still at 461, but the SMI's intervention sales they carry out, you see it's 490, 500. So it tells you that already within their own segment, within the official windows, you're getting some relaxation of the peg that you're seeing there. And we think over the year it would have to move higher. And the reason is because for foreigners to come into this market, I mean, the big issues we've had over the last 2 years have been low oil production, which has made not much in terms of oil inflows, and as well as also the subsidy as well. So central bank hasn't got much dollar inflows there. And then also, because interest rates were low, foreign investors didn't really come into the Nigerian market. And of course, because of the way we manage our FX system. So if oil production starts to pick up and interest rates are now much higher than we were, then the only thing that's left is for the current is what price do they feel confident in coming to Nigeria at. We don't think that price is a number that's sub 500 naira. We think it's a number that's higher than that. Yeah, where exactly, I don't know, but I don't think it's a number that's sub 500. That's my sense.
Yes, Oracle, well done. You nailed it. So, keeping that in mind, if we look at where the rates closed yesterday, and I guess so much has happened in that, since that interview with the exchange rate. I think the INE window closed at 770, parallel market was between 740 or 750 to 760, and then the Binance, the crypto exchange, the peer-to-peer trading within that range. So, are we seeing a convergence in the exchange rates?
Yeah, so last week when the news went out, I think what you're seeing is the market is trying to find a level. We're trying to see price discovery, because if we look at it for the last 7 or 8 years, we haven't really traded currencies. And so what I think you'll find is that most people sort of try to anchor at what's the closest thing to a sense of value. And I think that's where the parallel market rate comes in, because people sort of felt that, look, that's the next closest thing we could sort of anchor on. I think that's why you've seen that most trades, I think over the last 1 week, have been pretty much 700, 800, 700, not quite touching 800, but between 750, 760, thereabouts. And I think that's probably where the near term will settle. The big question then is what happens to dollar supply, because you have the huge demand backlog, but are we going to take any big steps to try and address the issue of dollar supply, given what we know about oil inflows? Oil prices have been supportive, but our oil production hasn't been quite strong. And then, of course, you have the issue with the subsidies. So I think the big question is if we can find some means of addressing that, either maybe you're going to borrow money significantly from maybe Eurobond issuance or the IMF or something, or maybe we'll have to adjust interest rates to a level that can attract large portfolio inflows. If we're able to do one of these two things to decisively address USD inflows, or asset sales as well, if we do carry out some asset sales, then I think we could start to say, okay, you know what, maybe the currency could strengthen. Most analysts or most reports I've seen suggest that at the current levels, the Naira is undervalued from a real perspective, so from a real effective exchange perspective. So that suggests that, okay, it's not, if the dollar supply issues are addressed, then you could see a scope for appreciation, but maybe not so quite soon.
So you see, you didn't, okay, in that case, what do you make of those, the loosening of restrictions that the CBN announced on Sunday, invisibles and visibles being allowed in the INE window and so on and so forth? Is this this wasn't, you didn't mention this, so is this, I was going to ask you whether this would lead to any supply increasing or coming into
So what I think the central bank is doing is, we've had 8 years of circulars, which pretty much created an unorthodox kind of system. Pretty much it created a system where there wasn't much influence from market forces. So what's going on now is there's a bit of an unwinding. So you're seeing there's probably going to be a lot of circulars over the coming days that would seek to unwind many restrictions that weren't there before. Cast your mind back 8 years ago. We didn't have some of these restrictions in place. There was no restrictions on how much you could bring into a domiciliary account in terms of cash, telegraphic transfers. You didn't have to. So my sense is the central bank appears to be on a path of normalization, and to do that would mean unwinding a lot of these measures, which a lot of people have felt, haven't helped the market work. A market works when many buyers, many sellers, nobody's able to influence anybody, and it's a free market, willing buyer, willing seller. And I think to support that ethos, that's why they're having to unwind most of these restrictions. Speaking of restrictions, the 41 item list is still restricted from the INE window. Is the Naira then freely traded if that is or rather, has the central bank, can it be said that the central bank has not completely taken its hand off the brake, since those 41 items are still there and can't be accessed by the INE window? Well, some of those 41 items, if you remember, are also items that I think on the customs prescription list. So there's also that layer there. But my sense is probably, we have, like I said earlier, we're dealing with supply issue. So these are basically demand side restrictions. So you probably won't be quick to get rid of some of those, although most people will say, look, from a visibility perspective or from a confidence building perspective, you should take those out. But I think it's still early days. Who's to say tomorrow they probably won't take it out? Right. My sense is it's probably still early days. I want to get to subsidies, but before I do, I want you to listen to this clip we had when we spoke with Mustafa Chike Obi, who is the chair of the Bank Directors Association of Nigeria. He's talking about the the triple-headed dragon of subsidies bothering Nigeria. Let's take a listen.
There's three subsidies that are killing Nigeria. The PMS subsidy, the FX subsidy, which I think is the most dangerous of them, and then there's electricity subsidy. Those three subsidies go up, in my estimation, over 10 trillion naira a year.
All right, so we've gotten rid of two. At least President Tinubu has taken out two of those, FX and the fuel subsidies. Remaining electricity. I want to ask you about tariffs that I believe are supposed to go up July 1st or so. I guess this is an obvious question. What does that do to disposable income? And then for people who might complain and say this is not the time to take them out, how do you walk that fine line between the impact on households and you not having enough money to continue those subsidies?
Yeah, I mean, it's a painful period. And I think that's the big problem with when you don't adopt a market system. It's that you would have to make occasionally when the pressure builds up and you're unable to keep prices in place, you would have to. And so you see these very big adjustments. And so, unfortunately, a lot of it is coming around the same time, which ultimately, again, goes back to the point. I mean, if you cast your mind back to the 1980 structural adjustment in Nigeria, it's the same cycle, really. So, which is you need to get to a market system. Under a market system, the price adjustments, once you've stabilized, would be small and in between. And so people will be able to adjust. But when you have these big adjustments, I think that's always where the problem is. With regards to electricity tariffs, I mean, the biggest problem with attracting investment into the sector, people have said is, look, you don't have cost-reflective tariffs. And I think that's really where the problem is. And so, I mean, in the last, we prioritized the power sector in 2014, and since then it's been a slugfest because each time the currency moves, you have to make an adjustment. And my sense is it's going to be painful. And yes, but if you look at the breakdown of the tariff adjustment, most of it, I suspect, and as with the last round, were carried majorly by the people at the higher bands. There wasn't that more adjustments for people at the more lower tariff bands. And I think if you live within rural areas, it's actually, I mean, it's really, really low. It means you're pretty much still going to be left with the same old tariff. So it's really people who live in the high or areas that are classified as tier 1 or stuff like that. So those are the ones that would bear the burden of adjustment. So yes, I think unfortunately, it's coincidence. I mean, it's a perfect storm. The perfect storm.
Okay, speaking of that perfect storm, you take fuel subsidy removal, the exchange rates, at least partially taking off the handbrake of the exchange rates, and electricity tariffs, even though it's at the top tier. You mash all those together, what's the inflationary impact there?
Well, we're looking at inflation, I think in our views, we're looking at it close to 30% if you push everything through. Yeah, close to 30. And the big driver, of course, will be fuel, because the fuel price increase is, I mean, it's effectively more than double. And given the way fuel price works with the economy in terms of transport, you're just going to see a very big shock over June. We think that pushes up month on month. We're likely going to end to maybe 26% in June. And then from then on, it's a slow crawl between 25, 30% over the rest of the year. Now, the important thing about these one-off adjustments in prices is that they tend to be disinflationary. So next year, you're looking at, I mean, if you don't have any big adjustments in oil prices or things like that, you could actually see scope for inflation to start slowing down significantly. I mean, you look at Ghana, you see a similar dynamic there. I mean, inflation last year ran at almost 50%. Now it's starting to come down because the shocks are worn off, and so they tend to be disinflationary. So my sense is, yes, you will have the big shocks this year. We're looking at that number running close to 30. And then from then on, it's in the second half of next year, the base effects you have from this year mean that you'll likely see much lower inflation in the second half of next year.
All right, great stuff. We'll have to leave it there. Wale Okunrinboye, Chief Investment Officer with Access Pensions. Thank you so much for joining us. Really appreciate your time.
Thank you.